Thanks very much, everybody, for coming in again. The housekeeping we've been through. Thank you for joining in. Your interest is very much appreciated. I'll do my darndest to make it worthwhile. I guess that made me do it. The information that I'm presenting is of a general nature and obviously cannot take into account your specific circumstances. So I have to ask you to take it with a grain of salt and run it past your own advisors. That's the usual stuff. Now, what do I want to cover today? As an agenda, I thought we'll keep it very simple and basic, but that's where the nuggets are. The how, the strategy, with whom, why. A lot of people get hung up on the why. I think that's an important point, and what to do next. Again, if you've got any questions, any issues, throw them in the chat by all means, and I'll open my chat now, and I will be able to see it. Terrific. Yeah, hello, Anthony. All right. So the how. By the way, my presentation style is that of straight down the line. As you can tell, English is not my mother tongue. I am originally from Germany, and we are said to be very direct. I don't mean to step onto anybody's toes with that, but I just say it as it is, so I trust that's okay with everybody. So on the how, do you want to look at property investment as a hobby or a business? Can I suggest that we look at it as a business? The reason is hobbies cost money, businesses make money if they run properly. Now, the point about a business is that we want to get it to that unemotional. I think it was Warren Buffett that said, you cannot expect to run a business if you can't run and own your emotions. So run property investment as a business, run it unemotionally, do the necessary steps, take the necessary steps, and you will succeed. To that, we suggest to do unemotional research offsite. So don't get lured into the next fad or the next thing that comes up in the media. By the time that the media gets hold of things, for example, the next hotspot, it's just about every time already too late. The reason for that is that the statistics are 3 to 6 months late in coming out, and that's what the media bases the information on. So you are 6 months behind the 8 ball when the information comes out. So not the ideal, it may still work, but not the ideal situation. So we suggest to do offsite research first, and then once the figures all stack up, whatever you do, go to the site. And we do a lot of our investments interstate. The reasons for that I will cover a little bit later. In the scheme of things, even a trip anywhere in Australia, for that matter, even if it was going to cost me $1,000, if I spend, say, $500,000 on a property investment, $1,000 to verify my offsite research is money well spent. Or get somebody that knows the area and that you are happy to appoint. That, of course, is also an option. But I find that having gone to the location that you want to invest in is worth the money. There are a lot of things that you cannot check up offsite on. And I'm a big believer in getting the vibe, the feeling, the situation, talking to the locals. And that is one of the reasons why we as property friends only select 3 to 5 areas per year that we invest in. And hey, by the way, let me cover that straight away. We have a very simple principle in our business, and that is only what's good enough for ourselves is good enough for our team. So, and the selection of the location is one of the most important things that you need to do as a property investor. So, if you want to achieve a duplicatable and a predictable outcome, then we need to do that via a system. And only that way you will get to an outcome that is predictable, that is duplicatable, and that is risk mitigated. So we all start with one property. Our system really is set up for a 3+ houses strategy. Why do I say that? Why is our system set up for that? Well, most people want to either aspire to financial independence, have choices in retirement. Some of us want to leave a legacy. Now, one investment property is great, but you don't change your life, you don't leave a legacy, you don't have choices in retirement or financial independence with one property. So we all start with one, and if you apply the right system and work with the right people, and again, the old adage applies. It's hard to soar with like an eagle when you are surrounded by turkeys. So the selection of team is very important. Then you will make it, and you will find that property investment is a very worthwhile and a very secure way of investing, because it is predictable and it is risk mitigated. The outcome is very much risk mitigated. One of the reasons why personally, and I'm not knocking crypto, but I can't hack the ups and downs, the vast variances in cryptocurrency, for example. Plus, I don't mind admitting, you can see it, the gray hair. I'm a bit old-fashioned. I believe in bricks and mortar. Land is hard to manufacture. Only the Dutch have been able to steal some land from the sea and put dikes around it and sort of manufacture some land. All right, the strategy, balance, yield and growth. And again, let me just have a check. Have we got any questions at this stage? No, that's okay. The strategy. I find that, and I've been doing this for over 20 years, too many people get killed by the wrong strategy. And if I've learned one thing over the last 20 years, you need to have a balance between yield and growth. That means between income, the short-term income, which is the rental income, and the growth, the appreciation of the property, which is the long-term income. Now, it's also fair to say that yield, the rental income, is the small money, and growth, the capital appreciation, is the big money. Now, this is very much a topic on its own, and I'm going to cover more on it a little bit later, because it is the crux of the matter why a lot of people get stuck and can only do one and are at pains with one property. So, time frame. Property investment is not a get-rich-quick scheme. Anybody that tells you that is a fool, or is wanting to get their hands onto your money. Minimum 5 years, better 10 years, needs to be allocated to property and to property strategy. You need that time to make it worthwhile, which is also the beautiful thing about property investment as an asset class. And by the way, I have looked at many asset classes, and when you go historically, it is quite hysterical, nice twist of words, that most wealthy people and the ultra-rich have built their initial fortunes on property investment because it is very stable. it is very predictable. So 5 to 10 years is the suggested time frame. Risk versus reward. The risk in property investment, if you half decently do your due diligence, is very low. So the rewards can be very big, and we are believers in time in the market is more important than timing the market. But if you can get at the right time into a market, then that is beautiful and the rewards are even bigger. But time heals all wounds in property investment because, again, and the experts are in different minds about that. My suggestion is in 10 years, the property should double in value. And of course, there are differences and ups and downs in the market, but generally we have a 10-year cycle. What is the right deal for you? Well, only one person can decide that, and that is yourself. And that is also the reason for us to offer 30 minutes discovery calls to everybody that is on the webinar tonight. We really want to come up with the right strategy for yourself. There are many ways to skin a cat in property investment, and I'm in the lucky position that I've got tons of experience, and we believe that the strategy needs to fit for you. There is no one fits all. There's different income situations, different risk profiles, different time frames that people want to run things for, and different outcomes that we're after. So property investment has to be a personal strategy that is customized. Now, I alluded to the fact that the combination, the balance between yield and growth, between rental income and capital growth or asset value increase is one of the most important parts. Allow me to drill down on that a bit more, because it is a very, very important point where most people get stuck. I call rental yield or the rental income the short-term money, because on a, say, fortnightly or monthly basis, we get our rental income. Now, that rental income should be high enough that the property, certainly at the very, very low interest rates that we have at the moment, that the property completely pays for itself. And this is where I personally feel that a lot of people get sucked into the negative gear line and buy properties in the major centers, Sydney, Melbourne, Brisbane. Usually the major centers are the ones where the cost of buying is very, very high. And due to the competition, the rental income is very low. If you don't have 5% rental yield minimum, you will be paying out hundreds, if not thousands of dollars per month from your after-tax money to fund the property. Sure, you're getting, say, 35% of that money back, but you need to cash flow that in the first instance, and anybody that goes into an investment for the tax benefits, again, forgive me, I'm going to give it to you straight, is looking at it from the wrong end. The deal needs to be good in the first instance, and then if the deal is good, we can, in the second instance, optimize the deal further with tax benefits. So a property investment should not, in my books, influence your lifestyle. It should not take money out of your pocket. And there are many ways to structure deals, to structure property investment, that it does not take money out of your pocket. Sure, it is unlikely to do that in Melbourne or in Sydney. But if I look at property investment as a business, I do my research, I look at the figures and I invest my money where my money is best invested. You wouldn't ask whether BHP sits around in the next suburb to where we live. It is interesting to me that with bricks and mortar, with property investment, people want to touch it, feel it, check on the height of the lawn or that the renter is doing the right thing. Yet with any other investment, we gladly hand the money over and we have the specialist looking at it, looking after it. So we're suggesting do the same. Treat property investment as a business. Invest your money in the best location that you can get it, where the return is the highest and which fits with your profile, with your specific customized strategy, so that it doesn't influence your lifestyle. The reason is, just imagine you have a situation like Sydney, 7 years, no growth. Say the average property, I bet my bottom dollar at $500 a month in negative gear. So you are forking out every month $500 of your after-tax money. That ain't fun. Why not structure a property investment deal so that it is not influencing your cash flow? Financing is, again, a very important point. Why we are looking for 5% and more of rental income. You can get one property if you are a high net income earner, or if you have high disposable income, you may be able to get two that are negatively geared, where you are putting, say, let's go with the $500 a month. But who in their right mind would want to take $500 out of my after-tax money every month and put it to what I call feed the dragon? Now, even if you can do it once, but can you do it 2, 3, 4 times? That is the problem. And you won't get financing for the second, third, or fourth property if you have highly negatively geared properties. So that's another reason for it. And yes, it is the small money. People that advocate very high rental yields, even if I have got $200, $300, let's call it $300 a month, a week, which would be a very high rental income after all expenses. That is what times 50 is $15,000. Now, no, that's not right, $1,500. It's a small money. Now, compare that to a, say, 10% increase on a $500,000 property. That's $50,000. Can you see that the parity is the ideal, the parity between the balance between rental income and capital growth? And typically, any market where the rental income is very high, the capital growth is low, and where the capital growth is very high, the rental income is low. That is the reason why we suggest balance. Okay, I'm getting on my high horse, I will keep on. High capital growth is the long-term money. That's the money where we need to sit on the property and have the increase in value over time give us the returns. And yes, it is great if we can get into a market at the right point in time. But again, timing the market is very challenging, very hard. And time in the market is where the capital gains come from. The long-term money, the increase in value will provide you with the lifestyle. So in general terms, we are talking about 3 phases of property investment. The accumulation phase, which is the first one, the one that amasses the biggest number of properties or value in a given time, wins. The consolidation phase, that's where you sit on your property portfolio and you allow the market increases to provide you with the long-term money, with the increase in your value of your portfolio. And then the repatriation phase, where you get into the lifestyle that you want to have. Again, that's where you retire your debt. That's where you sell a property or two. And that again comes back to the personalized strategy. This is why I'm harping on a personalized strategy. Refinancing comes through the long-term money. Refinancing comes through the increase in value. Now, again, isn't it a beautiful day when the property pays for itself, but the value increases have been sufficient to withdraw equity and buy the next one, have the deposit out of the next, for the next property out of the previous purchase. That's what the property rent system does. And we've been doing it for 20 years. You can go on our website. There is 50 plus testimonials there, some of which are video testimonials. So I'll cover that a bit later too. The long-term money, the capital increase is the big money. Okay, so why is it important to have both? Because we want to have the balance. On the one hand, we need enough rental income to have no influence on our lifestyle, but we want to also at the same time get the maximum capital gains that provides the balance, that provides for enough rental income. Why a roadmap? Why would you sit down? Well, it is pretty much the biggest expense that anybody of us, after our principal place of residence, after our family home, I guess, go through. So that needs to be, in my books, well planned, well structured, and well executed. Why? Because we want to increase the chances of success. I don't muck around. Planning is everything. So that's why it's important to develop your personal roadmap and follow the system that has been proven to work. The 3 phases I've already alluded to: the accumulation, get as many properties or value as you can get; the consolidation, sit on it, have the value increase, look after it; and the repatriation, which is fun, which is where you do whatever you want to do, whether you are after financial independence, whether you're after choices in retirement, or I want to leave a legacy to my kids. So, you know, that is again a very personal thing. There's nothing like a case study. The picture that you see is a property in Hobart, Midway Point. And this is why the on-site research is so important. If you can't do it yourself, that's okay. Employ somebody to do it. But it must be done. To buy off the plan, from plans, and I've been doing it for 20 years, you will never be able to establish what are my ocean views from this property. What are my ocean views from this property when the other buildings have come up? And how will my views be obstructed if there is a single story or a double story? That is the amount of detail that one needs to go through to secure your success. And you can't do that when you're only working off the plan. You need to understand the area. You need to understand, as a professional investor, who is who in the zoo. You need to understand the market very well. And we need to understand the different suburbs, the demographics of the different suburbs. Where are there changes? Which is where a lot of money can be made. So, I'm sorry, I get tangled up in these things. I love what I do and I make no excuses for it. I get emotional about it. That's the dog in the hunt. So this house and land package was bought for $360,000 in 2018. So just under 4 years ago, I think in October, November 2018. The house and land was $360,000. That is complete, turnkey, including window furnishings, gardens done, everything done, so that the tenants can take the key the next day and it can be rented out. The anticipated rental yield was 390. Now you can already see that this is 5.3, 5.4%. We don't do a deal under 5. So the rental yield at this point in time was estimated to be 5.6%. At those sort of figures, the property carries itself with all costs. And keep in mind, that's one of the reasons why we do new properties. I don't want to buy myself a hassle. Essentially, I want to buy myself a hassle-free investment, where certainly for the first 5, 6, 7 years, I don't expect any issues. So now let's see what happened. Today, so let's call it 3.5 years later, the value of the property is $550,000, so $190,000 up in 3.5 years. Not bad at all, which is, by the way, more than 50% on capital spent. And yes, we timed it beautifully in that location. The actual rent is $530 a week. So that's a rental yield of 7.1%. This property is actually paying the guys, and the area is still going up like there's no tomorrow. Now, I'm not saying that we can manage that every time, but the beautiful thing, and now I come back to strategy, with having high enough rental income that you can sit it out, is it doesn't influence your lifestyle. So you can sit on the property and you will get the capital gain. I often get asked, what's a hotspot? Well, a hotspot, I go initially by the figures. As I said, the offsite research is most important, and it's the starting point. So this is, hey, I can give it to you. It's counts. The rental vacancy rate, depending on which area you are in, counts. And hey, this is another interesting factor. There are areas that are 0.6 or 0.8% in counts, and there are areas that are 0.0% vacancy rate, which is unheard of. Generally speaking, between 3.5% to 4.5% is considered to be a balanced market. But in average, the vacancy rate is 0.4%. So that is tight as a drum. It's a great market for investors. The asking price in the last quarter went to $492,000. In the quarter, an increase of 10.6%. Now, I said it before, I'll say it again. Statistics are 3 months to 6 months behind. You will see the next set of statistics, the next quarter that's coming out. I fully expect another 10%. And by the way, we have got deals locked in already. The stock on the market was 73 properties. It is a 10-year low. Can you see a pattern here? The pattern is, it's a great time to buy. Now, on top of that, the weekly rent, the asking weekly rent, has gone to 501, or 11.3% up. Now, again, I stress the point. We have $501 a week in rental and an asking price of $492 million. So that is certainly a great rental return. Things that need to be checked as well is what's the development in the area. Are there shops? In this area, there's a big shopping center being established. The highway down south is being duplicated, and a big retirement village is being created. So all good investments, volume, sizable investments that spell population growth, that spell lots of work, that spell lots of money in the economy. And this is the things that you can only do when you do the local research and verify locally. We've got some people on the call that have been with us for a number of years, and they know I'm every 6 weeks on a trip, because we need to be in the market to be in the market. You need to know what's going on. So allow me to indulge myself a bit, tell you a bit about us and what we've been doing and where we've come from. With whom, whatever you do, and if you don't go with us, that's fine, but do your research on the advisors that you choose. We've been in business for 20 years. 76% of our business is returning clients. I'm very proud of that figure. Something is working here, which also means that we're doing the right thing. And our 7-step success system provides accurate, unbiased investment guidance. We have some training sessions that we run, which is our champion team meetings. We do them online these days. There's opportunities that we open up and we mitigate risks through our system. Full disclosure, you pay what we pay. We get paid for our service separate to the deal. I think that is hugely important again, and we've done that from day one this way, because I want to be able to stand up in front of you and want to be able to say that there is not a single dollar going in a brown paper envelope or that I get from the developers or from the builder that you don't know about. Because that to me is a big conflict of interest. Think about it. Ultimately, we serve the person that pays us. So if we get paid by a developer or by a builder, that ain't right. Our allegiance needs to be with you, our clients. Hence, we have made up the rule 20 years ago, we get paid separately to the deal. And I can look you in the eye and I can say to you, you pay the same price that I pay. And to that extent, I refer you to our client feedback. Hop on the website. There's some testimonials and some video testimonials. And allow me to play a 1-minute testimonial from our clients. Now, let me just check that I've got the sound on properly. How will I do that? Let me just, sorry, I just need to get out of here, stop the share for a second. And I just want to make sure that we have share the screen. And now I've got the screen share with the sound. That will be better. Okay. So allow me to play that little video. Oops.
G'day, I'm Dion and this is my wife Jacinta. We've just recently completed our very first home with Property Friends. That house is in Townsville. We've gone and inspected it and seen everything that's come together over the period of time during the build. We're very, very happy. With all the advice that we've been able to get through Property Friends, we've certainly had the encouragement and the confidence to pursue our investment path and tackle another one, which will be in another state, which will be ready very soon. Through Property Friends, we've been able to access information, advice sharing, and a whole network of people that's been invaluable to the confidence that we need to get our property portfolio started. Thanks.
Yeah. Really proud of the testimonials that we have, and Kiki, yeah, okay, that's fine. I will put the Kiki just send a message through that she'll have to drop off. As I said, I'll drop the recording into everybody tomorrow. Yeah, so I'm very proud of those testimonials, and quite frankly, you can't do what we've been doing for the last 20 years without any bad comments in the almighty Google, and the testimonials certainly show that we have got very happy clients and that our system works. So the why. It's all about you. Again, I come back to the personalized strategy. I can't hammer that enough. There is no one fits all. Get the information, verify the information, do your own due diligence. We can delegate, but we shouldn't be abrogating our due diligence. Where are you at? That includes, in my view, having an overview over your assets and liabilities. So what do I own? What do I owe? About my cash flow, what is my incoming monies? What do I spend? And what is left over at the end of the month? So we need to know that really to be able to make meaningful decisions and develop your personalized plan. Now, with all of these things, we can help you. I don't mind doing that. In fact, I love doing it because that way we get to know each other a bit and we can really customize the strategy. Then the next question is, where do you want to take this? What are you after? Are you after financial independence? Is that the holy grail? Are you after a very comfortable retirement with choices? Or do you want to leave a legacy? What drives you? Because that has to be the outcome. That has to be the goal. That has to be the end of the strategy. And then we develop a customized strategy and ideally a multi-property strategy. So take me up on the discovery call. It's for free. And if you don't do anything else, it'll be very beneficial. Because we want to establish a long-term strategy that works for you. I've been talking too much. I want to open it up to questions. If you want to, by all means, unmute yourself and let's let it rip. I'll have a look in the chat. Okay. One question that came through is, do you suggest a building inspection? That's from a person that I've been talking to previously. By all means, yes. We suggest a building inspection. We do them every time. The reason is very simple. Not only do we want to have an independent arbiter between the builder and the owner, but we also want to have a technical expert that is in a position to say this is good workmanship or this is not good enough. So yes, we appoint an independent building inspector every single time. And that is one of the things that Ulla and myself organize as a matter of course, as we do offer, and it is all optional, offer all the other services that we all need to everybody in the team. And I stress the point again, I don't get a single dollar for that. But it stands to reason that as a team we are stronger. It stands to reason that when I can get the building inspector to look after 5 to 10 buildings in one area per year, that they will look after us better. It stands to reason that a rental manager will be more interested in keeping and maintaining our business and looking after our business more, the more properties we have as a team. So that's why we do it. Okay, any other questions? LVR, is it worth it to go over 80%? LVR, loan to value ratio. So that is the amount of money that you put in yourself. In typical terms, typically 20%, and 80% comes from the bank. Most banks, if you go over 80%, so that means if you don't have the 20% equity, money yourself, they charge what is called LMI, Lender's Mortgage Insurance, which is an insurance for the banks, not for us as investors, that if anything goes wrong, the bank gets the money. This insurance is very, very expensive. If you were to go, say, on a $500,000 deal to 95%, which you can as an owner-occupier, relatively easy. As an investor, not that easy, but again, specific strategy. It will cost you some $15,000 on a $500,000 deal. So if you can see that you get as much equity together as possible. Now, having said that, if it stops you for year 2, 3 to invest, time in the market is more important than timing the market. Let me go back to my 10% on 500,000. I spend $15,000 LMI and get into the property market, say with a 10% deposit, any time of the year, when the property increase in value is 10% on 500,000, it's 50,000. And you got to be careful that the market doesn't outrun you there with your ability to save. So, yeah, there's many reasons to go over 80%, and there's many reasons to accept LMI. Okay. I've got here one more question. Have you got rental managers that you can refer? Yes, yes, we do. I've alluded to it. I think my wife and I are in the same game. We need the same services that we all need. So we tend to set up strategic alliances with partners that we can trust, that know how we work and what we do. And by giving them volume business, they are looking after us a lot more than your one property person. Question here, refinancing, Siggy, I think Siggy is asking that. Refinancing, to keep the interest only is getting harder and harder due to all the new bank regulations. Definitely. We just managed to refinance one of our 4 properties, but it took 4 months with a lot of difficulties. Is that the general idea of more investors? Yes. Again, that depends on your personal strategy, Ziga. In general terms, in the beginning of the game, we go interest only on everything that we can. Now, typically you can run that for 5 years in Australia. Interesting in America and in Europe, they do it for 20 and 30 years. But here in Australia for a maximum of 5 years. Then you need to refinance. It is challenging at the moment, but it can be done. Now, it again depends on your personal situation. If I have, let's say, one property only, and that one property is balanced, after 4 years, I would expect it to have increased in rent so that it pays additional money. I may be able to go to principal and interest. This is another reason why we suggest that at the beginning of the investment, the portfolio needs to be balanced. Over time, the rent is going to increase and you can create buffers for principal and interest. But yes, in the beginning, I definitely recommend to go interest only, because that secures your cash flow. And there is other ways you can secure your cash flow and make it easier. There's the tax withholding form, where you can take advantage of non-cash deductions in the tax return and get your tax refund that you would otherwise get at the end of the year every month, so to speak. This is a bit complicated, a bit detailed, so if you have questions on that, again, I refer you to the discovery form. So to answer your question, Ziga, yes, definitely. I would refinance a loan that is 3, 4 years, 5 years old, for the same reason also that the interest rate on the interest only that you have locked in would be very high. If I can refinance now at a fixed 5-year rate, 3 to 5 year rate, you not only have got a ceiling on your rental exposure. Yes, it will cost a little bit more now, but you have a ceiling on your interest exposure. I'm sorry, so you know what your costing is going to be for the next 3 to 5 years, and I like that, I have to admit. But interest only, definitely. Fixing can be argued, but interest only, definitely. Simply because it gives you a buffer. You can always pay, usually you can pay extra via a redraw account or an offset account is a great way of doing it. Okay, I'm getting the thumbs up, so obviously I've covered that. There's one other question here. Do you suggest a conveyancer or a lawyer? That's a very personal question. A lawyer will give you more detailed advice and will give you personal advice. And again, we've got great guys that we have as part of our team. A conveyancer will give you the run-of-the-mill, the processing, but they will be cheaper, no question. Ballpark, a conveyancer should be around $1,000 to $1,500. A solicitor will be $2,500. Now, what's your risk profile? How do you work? Do you want to have the personal one-on-one security, or are you willing to take some risk by just having somebody to process your transaction without looking at the building contract, without looking at the land contract, without giving you specific advice? That's a personal question. Okay, we are getting to the 7 minutes to mark. Feel free to, no, well, look, if there's any more questions, by all means, email me, or yeah, even better, take up the offer of the 30 minutes free discovery session. It took me 5 years to write my first book. I've in the meantime done some more, but seeing that you've been on the call, I'll make a special offer for $10 only. You can purchase this book. The link I will put into the email as well when I send out tomorrow the recording. So you can save some money. In there are the 7 steps that need to be considered for a successful property investment. Other than that, what's next? I would suggest book a strategy call. What have you got to lose? If anything, it's going to cost me money and time. And in an ideal way, we get to know each other a bit and see how we can optimize a strategy for you. Okay. Yeah, that's really all I wanted to cover. I trust this has been informative, has given you some pointers, has given you some ideas, some tips and tricks, and book in for a strategy call. Let's have a chat. Until then, have fun. Bye-bye. Thank you very much. See you next time. All the best.